Welcome to the Deep Dive. We're operating today as talk tickers, and our job is to get to the why behind the market's biggest reactions. And, well, today we have an absolute textbook case of volatility.
We do. We're digging into AngioDynamics Inc., ticker ANGO. They had their Q2 fiscal 26 earnings call on January 6, pre-market. And if you just saw the headlines, you'd think it was a home run. Strong beat, raised guidance, huge regulatory news.
And yet, what a completely wild day. I mean, the stock shoots up, what, nearly 10% in pre-market? Everyone's thinking this is the one.
Exactly. The optimism was there.
But then the market opens, and by the closing bell, all of that is just gone. The stock completely reverses, finishes the day down almost 13% on massive volume. That's a 22-point swing from the high to the low.
It's the ultimate market head-scratcher, isn't it? And that's our mission today, to really unpack that divergence. How does a company seem to do everything right? Growth, profit, catalysts, and then see its stock just collapse hours later.
So we have to go deeper than the headlines. It's about the quality of the numbers and maybe some shadows lurking in the background.
Precisely. Let's start with what got everyone so excited in the first place.
Okay, the numbers. Let's do the rapid-fire version. Top-line revenue, $79.4 million. That was way ahead of what analysts were expecting. It's an 8.8% jump year over year, a clean beat on sales.
And then you get to the earnings, and this is the initial shocker. Their adjusted earnings per share, so non-GAAP, came in at zero, break even.
Which sounds bad, but the expectation was for a loss of 10 cents. So that just blew the consensus out of the water.
It did. Now, to be fair, their GAAP EPS, the official number, did miss. It was a 15-cent loss. But that adjusted figure, that showed a real focus on managing costs.
And then came the signal that usually cements a rally, the guidance raise. Management came out and said they're lifting their full-year sales forecast to between $312 and $314 million.
And they bumped up their adjusted EBITDA guide, too, to a range of 8 to 10 million. I mean, a beat and a raise, that's the playbook. The market should love that.
Should. But this is where the story starts to turn, isn't it? We have to pivot from the quantity of the beat to the quality.
Exactly. The strategic story is working perfectly. Their pivot to what they call medtech, these are their higher growth, higher margin products. That part of the business grew 13%. And this is the key number. MedTech is now 45% of their total revenue.
So that shift is really happening. It's not just talk anymore.
Right. And you see it directly in their margins. Gross margin hit 56.4%. That's up 170 basis points from last year. And they said it's because of that product mix, some price increases, and their manufacturing initiatives starting to pay off.
Okay, so that all flows down to that adjusted EBITDA number, the one that was so impressive.
Yes, $5.9 million, nearly double the $3.1 million from the year before. But, and this is the but that I think unraveled the whole story for investors later in the day.
Here we go.
That 5.9 million figure, it included about 1.4 million from a, let's call it a one-off, non-recurring transaction related to a distribution deal in France.
Hold on. So if you pull that out, that one-time benefit, the real operating EBITDA is closer to what? 4.5 million?
That's the math. And that completely flips the script, doesn't it? This is where the skepticism starts to creep in. That France deal wasn't core profit. It was likely an inventory buyout or a contract settlement.
So management raises the full year guide by 2 million, but they just got a 1.4 million non-recurring boost in this quarter. It makes you wonder how strong the underlying business really is.
Precisely. Inventors hate that stuff. It clouds the picture. And that skepticism got even worse when they started talking about future costs.
Right. The manufacturing transfer. They're moving production from Queensbury to a partner down in Costa Rica.
Which is the right move for the long term. It'll save money. But in the short term, management was very clear. They expect temporary structural underabsorption in the second half of the year.
Underabsorption. That's just a fancy, painful way of saying you're paying for two factories at once for a little while, which, crushes your margins.
It's a recipe for instability. You have this one-time profit boost in Q2, followed by a guaranteed cost headache in Q3 and Q4. Not a great look.
They did mention generating some cash, though, $4.7 million in Q2, which is good. And they expect to be cash flow positive for the full year.
Which is important, yes. But let's not get totally bogged down in the financials because the actual products, the operational engines, are firing on all cylinders. This is the real long-term story.
Okay, let's talk platforms. Auryon, their laser system.
Auryon is on a tear. $16.3 million in revenue, up almost 19%. And get this, It was its 18th consecutive quarter of double-digit growth.
18. That's incredible consistency.
It's sustained momentum. They're getting into more hospitals. They're growing overseas after getting their CE mark. It's a real workhorse.
And what about NanoKnife? That's their big prostate cancer play.
Also very strong, up 22% to $7.3 million. But the huge news for NanoKnife wasn't in the quarter's numbers. It's what just happened on January 1st, 2026. They got a dedicated CPT code.
Okay, pause here. For our listeners who don't live in the med device world, break that down. Why is a CPT code such a massive deal?
It's everything. A CPT code is the billing code doctors and hospitals use to get paid by insurance. Without a dedicated one, it's a messy, uncertain process. A hospital has to wonder, if we do this procedure, are we actually going to get reimbursed?
So it removes all that uncertainty.
Completely. It standardizes payment. It de-risks the procedure for the entire hospital administration. It's the key that unlocks widespread adoption. Now, management was smart to say uptake will be gradual, but this is the single biggest catalyst they could have gotten for that product.
Got it. And the last piece of the puzzle is their thrombectomy business.
Right, mechanical thrombectomy. The whole segment grew about 4%, but the star inside of it is AlphaVac. That device was up over 40% to $3.5 million. It just keeps growing.
And this is where the regulatory news just gets almost comical. It's like they saved up a year's worth of good news and dropped it all at once.
It is truly rare to see this. 3 major wins in one quarter. First, they got IDE approval for their Apex return study.
IDE being investigational device exemption, the FDA's green light for a big human trial.
Exactly. This trial is for treating pulmonary embolisms, and it's designed to show the device can collect, filter, and put the patient's own blood back in during the procedure. That means less blood loss, which is a huge deal for doctors.
A major competitive advantage if it works. Okay, what was number 2?
IDE approval for the PAVE study. This is totally different. It's for using their device to remove infections off the heart valves. It's a really sick patient population with few good options. This opens up a whole new market for them.
And the third one?
A 510K clearance for their AlphaVac. It sounds technical, but it basically lets doctors inject contrast dye through the device while they're using it. It just makes the tool more flexible and easier to use.
So let's recap. The core business is humming. Sales guidance is up. And they land 3 massive regulatory wins that could drive growth for years. So we come back to the big question. Why on earth did the stock get crushed?
And here's where we connect it all back. The market sold off, and sold off hard, not because of the operations, but because of a huge strategic risk that overshadowed everything else.
Leadership.
The CEO, Jim Clemmer, announced he's going to retire sometime in the next fiscal year once they find a successor.
And in small cap medtech, that is just, it's a killer. A CEO change creates so much uncertainty. Will the new person stick with the strategy? Do they know the doctors? Do they know the investors?
It's paralyzing. And think about the timing. You have investors already looking sideways at that 1.4 million France benefit, wondering about the quality of the earnings.
Right. They're already a little skeptical.
And then on the same call, you drop the bomb that the CEO who engineered this whole turnaround is leaving. It's a double dose of uncertainty. Financial skepticism plus leadership risk. That's the combo that sparked the sell-off.
It completely drowned out all the good news. I mean, they even mentioned they won a patent lawsuit, which saves them a potential $3 million payment. Nobody even cared.
No one cared. All they saw was that management raised the sales and EBITDA guide, but they left the adjusted loss per share range unchanged. Investors are thinking, all this growth is just getting eaten up by tariffs and these temporary manufacturing costs, and now we don't even know who will be in charge next year.
So they just hit the sell button, a textbook case of fear-trumping fundamentals.
It really is. The platforms are executing, but the leadership question created a vacuum, and the market hates a vacuum.
Okay, this is the perfect setup. We've reached the part of the deep dive where we put on our most aggressive thinking caps. This is not financial advice, but it is an analysis of a, let's call it outrageous but plausible trade idea based on this dislocation.
And the whole trade is built on one core belief. The market has wildly overreacted to the CEO news and is completely ignoring the real quantifiable value of those 3 huge regulatory wins.
The idea being that a new CPT code and 2 IDE approvals for major new markets is a multi-year tailwind. That's a much bigger deal than a temporary leadership gap, right?
That's the entire thesis. So we'd call this the catalyst pair trade. It's designed to isolate the value of those catalysts from all the market noise.
Okay, lay it out. Action 1.
Action 1, go long and go equity. Simple. You're betting that the medtech pivot is real, the growth is real, and the current stock price severely undervalues these massive de-risking events. You're betting that 12 months from now, the market will care a lot more about these new market opportunities than who the CEO is.
But you're exposed to the whole market, the whole sector going down. So what's the hedge?
Action 2 is the hedge. At the same time, you initiate a short position on a competing company. Specifically, a peer in the cardiovascular space that has, say, all its eggs in one basket with a single product, or maybe a company that is facing its own difficult regulatory hurdle in the near future.
I see. So the short position protects you from broad sector weakness, and you're making a pure play on Angio's specific catalysts outperforming a competitor's challenges.
Exactly. The bet is that Angio's fundamental execution and regulatory wins will overcome the short-term leadership anxiety. The risk, of course, is that the new CEO isn't great, or the manufacturing costs are worse than expected. But after a 13% drop, the risk-reward looks pretty interesting.
So to bring this all home, Angio delivered a quarter that shows their strategy is working. The move to medtech, Auryon, NanoKnife, AlphaVac is paying off in both growth and profitability.
And their regulatory team just had an absolutely monster quarter. They de-risked their future and opened up massive new markets. The path to sustainable growth is clearer than ever.
But the market reaction was a brutal reminder of how much investors in this space hate uncertainty. They chose to sell first and ask questions later about the new leadership.
Which leaves us with the final provocative thought for you to chew on. When you look at Angio's future, which one matters more? The quantifiable multi-year growth drivers from these massive regulatory and reimbursement wins, or the unquantifiable short-term risk of a CEO transition?
The information presented here is for informational purposes only and is certainly not investment advice. Thanks for joining us for this deep dive into the wild ride of Angio's Q2 earnings.